Let me ask you something. If the world becomes more unstable, if inflation rises, if rates change, if stocks fall, if oil spikes, if fear returns, should every part of your portfolio react the same way? No. And that is exactly why balanced portfolios exist. Because real investing is not just about buying assets. It is about assigning jobs. Some assets are there for growth, some for stability, some for liquidity, some for protection. And if you do not understand the role of each one, your portfolio may look diversified without actually being structured. Welcome back, or welcome for the first time. This is GrisiekCapital, and this channel is about building real wealth the calm, structured way, without hype, noise, or fake certainty. This is week 5 of the Global Wealth Foundation. So far, we've talked about wealth, investing, funds, diversification, and behavior during crashes. Now we move into the next layer, asset classes. Because if you are building a real portfolio, you need to understand what different assets actually do. If you want practical long-term investing education explained clearly and step-by-step, subscribe so you do not miss the next lessons. And if this topic matters to you, leave a like. It helps this series reach the right people. Now let's start with the foundation. A lot of beginners think the goal is to find the best asset, the one asset, the perfect asset. The asset that grows fast, never falls, protects against inflation, stays liquid, and makes you feel safe. That asset does not exist. This part matters, because different assets exist for different reasons. Stocks are not bonds. Bonds are not gold. Gold is not cash. Cash is not real estate. Crypto is not a substitute for portfolio structure. Let me say that again. Different assets solve different problems, and once you understand that, portfolio construction becomes much more logical. Instead of asking, which asset is best? A better question is, what job do I need this part of the portfolio to do? That is a much more adult way to think. And honestly, that is where many beginners level up. Not when they discover a new ticker, but when they stop seeing assets as hype categories and start seeing them as tools. Now, before we go asset by asset, there is one principle you need to understand. Every asset class comes with a trade-off. If you want higher growth, you usually accept more volatility. If you want more stability, you often accept lower return potential. If you want liquidity, you may sacrifice long-term purchasing power. If you want inflation protection, you may need to accept uncertainty in timing. If you want tangible exposure, you may accept lower liquidity and higher complexity. This part matters, because portfolio construction is not about finding perfection. It is about choosing trade-offs consciously. And one more thing. A portfolio can look diversified without being truly structured. Owning many positions is not the same as assigning clear functions. You can own 5 different things that all depend on the same macro story. You can own 10 tickers and still have one-dimensional exposure. So do not confuse quantity with structure. A structured portfolio is built around roles, not around the number of positions. Let's begin with stocks. Stocks are ownership in businesses. And in a long-term portfolio, their main role is growth. That is their job, not emotional comfort, not daily stability, growth. If companies keep producing goods, services, profits, innovation, and cash flows over time, stocks have the potential to compound wealth. That is why stocks are usually the engine of long-term portfolios. But that growth comes at a price: volatility. Stocks can fall hard. They can reprice quickly. They can react to recessions, rates, geopolitics, policy mistakes, bubbles, and sentiment. So if you want the return potential of stocks, you must also accept the instability that often comes with them. This is where many beginners get confused. They want stock-like returns with cash-like comfort. That combination usually does not exist. Now think about history. There were periods when stocks delivered extraordinary long-term wealth creation. There were also periods of severe drawdowns, crashes, lost years, and major reevaluations. And even now, geopolitics can hit equities fast. For example, during the current conflict involving Iran, higher oil prices and stronger inflation fears have added pressure across equity markets. Reuters reported Brent at $112.57 on March 29, 2026, while AP and Reuters both described broader weakness in stocks as the conflict deepened and energy shock fears increased. So what does that teach you? Stocks are powerful, but stocks are not a complete portfolio by themselves for every person and every situation. Ask yourself honestly, can you handle the fact that the part of your portfolio designed for growth will sometimes be the part causing the most discomfort? Now let's move to bonds. Bonds are often misunderstood. A lot of beginners think bonds are simply safe. That is too simplistic. Bonds are loans. You lend money to a government or a company, and in return you receive income and principal according to the bond's terms. So what is the role of bonds inside a portfolio? Usually three things: income, relative stability compared with stocks, and sometimes diversification. But this is where precision matters. Not all bonds behave the same. Short-term bonds are not long-term bonds. Government bonds are not corporate bonds. High-quality bonds are not high-yield bonds. And interest rates matter a lot. When rates rise, many existing bonds can fall in price. When rates fall, many bonds can rise in price. So bonds are not risk-free in the way beginners often imagine. This part matters, because some people add bonds expecting zero movement, and then get surprised when bond prices fall. So think of bonds this way. They are usually lower volatility than stocks, often lower return than stocks over very long periods, but potentially useful for structure, cash flow planning, and reducing total portfolio aggression. In some environments, they help. In other environments, especially inflation shocks, they may disappoint. We saw that recently as well. Reuters reported that when Iran-related oil shocks revived inflation fears, bond prices also came under pressure while yields moved higher, which is exactly the kind of environment where bonds may fail to protect cleanly. So if you are new, hear this carefully. Bonds are not there to impress you. They are there to change the behavior profile of the portfolio, and that can be very valuable. Now let's talk about real estate. Real estate is one of the most psychologically attractive asset classes. Why? Because people can see it, touch it, understand it physically. A property feels real in a way a brokerage statement often does not, and that psychological clarity matters. Real estate can offer rental income, potential long-term appreciation, some inflation linkage, and diversification from financial assets. But real estate also comes with trade-offs. It is not highly liquid. It has costs, maintenance, taxes, financing risk, tenant risk, regulation risk, regional concentration risk. And this is important. Real estate is often treated like safe wealth simply because it looks physical. But physical does not mean risk-free. Property markets can stagnate. They can become expensive. Rates can pressure affordability. Regulations can change. Local supply can shift. So what is real estate's role in a portfolio? Often, income, tangible exposure, and long-duration asset ownership. But real estate usually should be understood as a serious asset class with operational complexity, not as magic. If you own one apartment in one city, that is not the same as owning diversified global real estate exposure. Let me say that clearly. One property is not the same as a diversified property portfolio, so again, function matters. Real estate may play a meaningful role, but it is not automatically the answer to everything. Now let's move to gold. Gold creates strong opinions. Some people see it as timeless protection. Others see it as dead weight. the truth is more nuanced. Gold is not a productive asset in the same way stocks are. It does not generate earnings. It does not compound through business growth. It does not pay rent like property. It does not pay contractual coupons like a bond. So why do people own it? Usually for one or more of these reasons: store of value thinking, crisis hedge thinking, currency distrust, or portfolio diversification. Gold often becomes emotionally important when trust in systems weakens. War, inflation, fear, currency fear, sovereign stress, political instability. That is why gold often attracts attention when the world feels fragile. But do not oversimplify it. Gold does not always rise exactly when people expect, and it is not a perfect shield in every crisis. For example, Reuters noted that in late March market stress linked to the Iran conflict, gold did not behave like a clean one-way hedge. In some of the panic, gold also sold off while the dollar benefited more consistently. That is a very important lesson. Gold is not magic. It is a tool. So how should a beginner think about it? Not as the center of a growth portfolio, more as a possible stabilizing or hedging component for specific portfolio goals and risk beliefs. If you are new, do not rush to extremes here. Gold is neither useless nonsense nor guaranteed salvation. Now let's talk about cash. Cash is underrated in some conversations and overrated in others. People either treat it like trash or like safety itself. Both extremes are simplistic. Cash has a very clear role: liquidity. Cash gives you optionality. Cash gives you flexibility. Cash helps with emergencies. Cash reduces forced selling risk. Cash can lower psychological stress. That matters more than people think, because one of the biggest portfolio mistakes is being forced to sell long-term assets for short-term needs. That is where cash can be very useful. But cash has a weakness too: inflation. Over time, inflation can erode purchasing power. So cash usually is not a long-term growth engine. It is more like a functional reserve, emergency fund, near-term spending, dry powder, psychological stability. And in unstable moments, investors often run toward cash and the US dollar. Reuters and AP both described this dynamic during the current Iran-related market stress, alongside pressure on several risk assets at the same time. That teaches another important lesson. Sometimes cash is not exciting, but it can be strategically powerful. Again, function, not hype. Function. Now we need to talk about crypto, and we need to do it clearly. Crypto should not be explained to beginners as if it belongs in the same role as broad global equities or high-quality bonds. That would be intellectually lazy. Crypto is a different category: high volatility, high narrative sensitivity, high uncertainty, high upside potential in some scenarios, and very high behavioral risk for undisciplined investors. So what role can crypto play for some investors? A speculative satellite allocation, not the foundation, not the emergency fund, not the stability bucket, not the retirement core by default. Could crypto continue to evolve? Yes. Could parts of the ecosystem matter in the future? Yes. Could regulation, adoption, infrastructure, and institutional involvement change outcomes? Also yes, but this is where maturity matters. You do not put a high volatility, uncertain asset in the portfolio and then pretend it behaves like a global core holding. That is how people fool themselves. So, if crypto exists in a portfolio, it should usually be understood honestly as higher risk exposure, with sizing discipline, and with full acceptance that future outcomes are much less predictable. That is the neutral adult view, not blind worship, not blind dismissal. Now let's bring this together. Asset allocation is one of the most important concepts in investing, because a portfolio is not supposed to be one hero asset doing everything. It is a team. Stocks may drive growth. Bonds may reduce aggression and add income. Cash may provide liquidity. Gold may provide some hedge behavior in certain environments. Real estate may add income and tangible exposure. Crypto, if included at all, may sit in the high-risk speculative corner. Do you see the difference now? The question is not which one wins. The question is, what combination creates a portfolio I can understand, hold, and survive? That is a much smarter question, because in the real world, environments change. Sometimes inflation matters more. Sometimes recession matters more. Sometimes rates dominate. Sometimes geopolitics dominate. Sometimes growth dominates. Sometimes liquidity dominates. Future environments will not always look like the past. That is exactly why portfolio structure matters. If inflation rises again, one mix may behave differently. If recession deepens, another mix may respond differently. If we get another war-driven commodity shock, a different part of the portfolio may matter more. If technology booms again, growth assets may dominate. You do not know the future with precision. So a balanced portfolio is not about predicting perfectly. It is about respecting uncertainty. And one more thing. Balanced does not mean every asset gets the same weight. Balanced simply means the portfolio has roles, proportions, and internal logic. The right mix can look very different from one person to another. In mature portfolio construction, not every asset belongs in the same layer. Some assets may belong in the core. Some may belong in satellite positions. Some may not belong at all for certain investors. That distinction matters. And next week, when we talk about actual portfolio models, that idea will become even more practical. Let me make this practical. Think about the past. There were periods where stocks massively outperformed. There were periods where inflation punished fixed income. There were periods where gold became emotionally attractive. There were housing booms and housing stress. There were cryptomanias and crypto collapses. Now think about the present. Right now, the ongoing Iran conflict is showing exactly how one geopolitical shock can affect multiple asset classes at once. Oil has surged. Inflation fears have increased. Stocks have weakened. Some bonds have failed to protect cleanly. Gold has not been a perfect one-direction hedge, and cash or the dollar have regained importance. Reuters and AP have both described this broader pattern in March 2026 coverage of the conflict and markets. Now think about the future. Maybe future shocks come from war. Maybe from debt. Maybe from AI disruption. Maybe from energy instability. Maybe from regulation. Maybe from recession. Maybe from something nobody is talking about today. And this is exactly the point. A portfolio should not be built on the assumption that one story will dominate forever. That is not investing. That is narrative dependence. Balanced portfolios exist because the future is uncertain. So what do beginners usually get wrong here? First, they chase recent winners. Second, they confuse familiarity with safety. Third, they think physical assets are automatically safe. Fourth, they think cash is useless because it does not grow. Fifth, they think gold must always protect. Sixth, they think crypto must either replace everything or be ignored completely. And seventh, they forget that a portfolio is not judged only by returns in easy times. It is also judged by how it behaves in difficult times. This is where most beginners get tested, because portfolio building is not just math, it is behavioral design. Can you hold it? Can you understand it? Can you explain why each part is there? Would your plan survive a hard year? Ask yourself honestly, if I removed one asset from my portfolio, would I even know what role I just removed? A portfolio is not only built for markets, it is built for the investor who has to live through those markets. So let's bring this together clearly. Stocks are mainly for growth. Bonds can provide income, structure, and lower volatility, but they are not magic. Real estate can offer income and tangible exposure, but with liquidity and concentration trade-offs. Gold can act as a hedge or diversifier in some environments, but it is not a productive compounding engine. Cash provides liquidity, flexibility, and emotional stability, but not long-term growth. Crypto is best understood as a high-risk speculative category, not a default portfolio foundation. And asset allocation matters because the future is uncertain. Function matters more than hype. A portfolio is not a shopping cart. Exposure without purpose is not strategy. So if this video helped, comment structure. And if you know someone who thinks a portfolio is just by whatever is going up, send them this video. Thanks for spending this time with me. This is GrisiekCapital, calm, structured, long-term investing education. Next week we move into actual portfolio strategy models. One asset concepts, 60/40ths, aggressive versus conservative structures, and how beginners can think about portfolio design with less stress. Until then, think in systems, think in functions, and build with structure. I'll see you in the next one.